Hello there. We're about to get into one of the single biggest moments in any entrepreneur's life, selling your business. Now, this isn't just another deal. Nope. This is the grand finale, the culmination of all those late nights, the risks, the sheer hard work you've poured in. To help us navigate this, we're using a fantastic guide put together by the experts over at ProTax Accountant, specifically for business owners like you, right here in the UK. So let's get into it.
So let me just start by asking you this. Have you really thought about it? I mean, really planned for what is, without a doubt, the most important sale of your entire life? This isn't like selling a car or a house. You can't just wing it and hope for the best. Getting this right and getting the reward your work deserves takes real strategy and planning. All right, here's a quick look at our roadmap. We're going to kick things off with how to get your business ready for sale. Then we'll explore two of the main routes you can take, the classic trade sale or keeping it in-house. After that, we dive into the bit everyone wants to know about, the tax. And finally, we'll tie it all together to help you figure out what your perfect exit looks like.
Okay, let's jump into our first big topic, getting your business sale ready. And honestly, it doesn't matter one bit who you plan on selling to. Whether it's your biggest competitor or your own management team, this step is absolutely non-negotiable. This is the foundation for a smooth, successful, and, most importantly, a really profitable exit.
I love this analogy. It's spot on, isn't it? You wouldn't just rock up to the Olympic Games without years of intense training. Selling your business is exactly the same. The amount of effort you put into preparation now has a direct, massive impact on your final valuation. Every clean spreadsheet, every documented procedure, it all builds buyer confidence. And you know what confidence equals? A bigger check.
So what does this Olympic training actually look like in practice? Well, it boils down to these four key things. First, your financials. You need to get your house in order. Any serious buyer is going to go through your numbers with a fine-tooth comb, so having 3 to 5 years of squeaky clean records is vital. Second, legal stuff. A messy shareholder agreement or a missing license can be a total deal breaker. Get it sorted now. Third, operations. You have to prove this business can run without you. Well-documented procedures are your proof. And finally, get a list of every single asset you own.
Now, lean in for this one because this is a real golden nugget of a pro tip. The best time to start planning your exit isn't when you feel like leaving next year. It's 3, 4, even 5 years before. Why? Because that gives you plenty of time to fix any problems and, crucially, to prove that the business is a well-oiled machine that doesn't need you there every day. That independence, that's what buyers are willing to pay a serious premium for. And when I say assets, I'm not just talking about the office furniture. The real value, your hidden gold mine, is often in the stuff you can't touch. We're talking about your trademarks, your domain name, those long-term client contracts. How solid are your supplier agreements? All of these intangible assets add up. Documenting them properly can seriously boost your company's value way beyond what you might expect.
All right, so you've done all the prep work, the business is looking sharp. Now what? Let's explore your first big option, the trade sale. This is what most people picture when they think of selling up. It's usually the best route if your number one goal is to get the maximum possible price and walk away into the sunset. So, what exactly is a trade sale? Well, it's pretty straightforward. You're selling your company to an outside party. That buyer might be a competitor who wants to expand their market share, or maybe a private equity firm that sees potential. The main outcome for you is typically a clean break. You get the cash and you're out. But is it the right choice for you? You have to be honest with yourself. A trade sale is perfect if you want that complete exit and the biggest possible payday. But remember that crucial requirement. The business has to be able to run without you. You also need to brace yourself for a long and pretty intense process because buyers will scrutinize everything. And I can't stress this enough, the tax bill can be massive, which means getting expert advice isn't just a good idea, it's essential.
Right, let's switch gears completely. What if your goal isn't just about the money? What if it's about legacy, continuity, and rewarding the people who helped build your dream? That's where keeping it in-house comes in. And there are two main ways to do this, a management buyout or an employee ownership trust. First up, the management buyout, or MBO. The name says it all, really. You sell the business to the people who are already helping you run it, your management team. The huge advantage here is continuity. They know the business, they know the clients, they know the staff. It often leads to a much smoother and faster transition for everyone. Now for the second in-house option, the Employee Ownership Trust, or EOT. And this is a really fascinating model. Instead of selling to a select few managers, you sell a controlling stake that's more than half the company to a specially created trust.
That trust then holds the shares for the benefit of all your employees, making every single one of them a beneficiary of the company's future success.
So, an MBO or an EOT, how on earth do you choose? Well, an MBO is great if you have a rock-solid management team and you want to phase out gradually. An EOT is perfect if preserving your company's unique culture and rewarding every single employee is what matters most to you. But here's the kicker. Look at the tax benefit. With an EOT, you could pay zero. That's right, zero capital gains tax on the sale. The funding is also different. MBOs can be tricky to finance, often needing bank loans. With an EOT, you are typically paid out of the company's future profits.
And just in case you think this is some niche idea, think again. The number of employee-owned businesses in the UK has exploded, more than doubling since 2020. So many founders are seeing this as a powerful, socially responsible way to protect their company's future and its people. For them, it's about more than just the final number on a balance sheet.
Okay, no matter which path you're leaning towards, there's one business partner you can never ignore: HMC. Let's talk about the tax man, because understanding the tax implications is absolutely critical. It's the difference between the headline sale price and the actual amount of money that lands in your bank account.
Let's start with the absolute basics. For the 2025 to 2026 tax year, every person in the UK gets a capital gains tax exemption of $3,000. It just means the first $3,000 of profit you make is completely tax-free. Now, in the grand scheme of selling a business, it's not a lot, but hey, it's a start. Everything you make above that is taxable. Now, that £3,000 allowance is for everyone, but for business owners, there's a much bigger prize. It's called Business Asset Disposal Relief, or BADR, and this is a potential game changer. If you qualify, it allows you to pay a significantly lower rate of capital gains tax on up to the first £1 million of profit you make from selling your business over your entire lifetime. This can save you a fortune.
Now, you really need to pay attention to this next part. Stay with me, because this is absolutely crucial. If you were thinking the BADR rate was still a lovely 10%, I have some bad news. That's gone. As you can see, the rate shot up to 14% in April 2025. And worse, it's set to go up again to 18% from April 2026. This creates a massive sense of urgency. The timing of your sale could literally cost you tens of thousands of pounds in extra tax. And look at the stark contrast with an EOT sale, which is still sitting pretty at 0%.
Whew. Okay, we have covered a lot. We've talked about preparation, the main options on the table, and the all-important tax man. So now, let's pull it all together. Because planning your optimal exit isn't just a business decision, it's a deeply personal one. It's about making sure your strategy lines up with your own life goals.
Ultimately, after all of that, the big question is, which way do you go? And I can't answer that for you. Nobody can. There is no single best strategy. The right path for you depends entirely on what you want to achieve, both financially and personally. So it's time to do a little soul searching. So grab a pen or just take a moment to think about these questions right now and be brutally honest. Do you want to sell up and never look back? Or does a gradual handover feel better? How much do you care about the company's culture after you're gone? Is it truly all about getting the highest price, or do other things matter more? Answering these questions is the first step to creating a plan that you'll be happy with for years to come. Okay, and before we finish up, here's the important official bit. Please remember that everything we've talked about today is for general guidance. Your business, your circumstances, they're all unique. So please don't use this as the only basis for making any big financial decisions.
So what's the real takeaway here? It's that selling a business is complex, and the stakes are incredibly high. To get it right and to create that optimal exit plan that really works for you, you've got to speak to the experts. The team at Pro Tax Accountant lives and breathes this stuff, and they can give you the tailored, specific advice you need. You can reach them easily on WhatsApp or by phone at 07985 689912, or just drop them an email at info@protaxaccountant.co.uk. Thanks so much for joining me today.